Good morning. Welcome to all of our participants from wherever you're dialing in from around the world to this very special session. My name is Doug Turnbull, and as you'll see in my bio, I'm responsible for the Canadian operations of DBRS Morningstar Limited. For those of you unfamiliar with my company, we're the leading credit rating agency in Canada and the fourth largest in the world, and we're headquartered in Toronto. Our company provides expert analysis, opinions, research, and commentaries on the creditworthiness of banks, insurance companies, corporations, and governments around the world. We rate credit cards and mortgages, auto loans, and student debt, as well as most structured finance entities. We rate Major League sports teams and their facilities. We rate container terminals and ports, toll roads, pipelines, universities, and hospitals, as well as power generating facilities. And we rate project finance and infrastructure in pretty much all its forms. And I might add, we provide investors with a long-term issuer rating for ECN Capital, an investment-grade credit at BBB low with a stable trend. We and our parent company, Morningstar, Inc., a global provider of independent equity and mutual fund research, operates in 28 countries around the world. As mentioned at the outset, Steve Hudson is one of Canada's most respected CEOs, and I might add, notable for his entrepreneurial success, both in Canada and the United States. Steve's bio is included in your notes, so I won't go into further detail, but I will say that the company he founded, ECN Capital, is a powerhouse in consumer finance in the United States. Over the next 25 minutes, we look forward to providing you all with a good understanding of its business and how Steve thinks about the industry and ECN's future. And with that, let's get right to it. Steve, let's spend a few minutes on the ECN story and give us a snapshot on what ECN Capital looks like today.
Well, good morning, Doug. It's great to see it, albeit virtually. And maybe before we turn to U.S. consumers and credit markets and financial services, I'd like to take a second and acknowledge the millions of people who have been impacted by COVID and those who have lost a family member. We're fortunate to see some rays coming through this morning with one vaccine approved and a second on its way. Which should bode very well for recovery. A little bit about ECN. We are a provider of consumer credit through three of our businesses, specifically in the housing market, in home improvement and in mortgages, as well as in the credit card market. We do it on behalf of the 90 U.S. banks, credit unions, life cos, and pension plans who are partners. And probably best to give you an example of what that means. If you're a U.S. bank looking for $500 million of prime and super prime home improvement loans, you're probably going to call us because we can find those loans and, more importantly, manage them for you. If you're a U.S. bank looking to acquire the GM credit card business, chances are you're going to call us. So 90 customers who are banks, credit unions, life cos, life insurers, and sovereign wealth funds, all U.S. based, and about $35 billion of assets that we manage, Doug.
Wonderful, thank you. Obviously, the story of 2020 is the global pandemic and its impact not only on governments and businesses, and tragically on individuals, but also on consumer credit. I wonder if you could give us some insight into how you see consumer health immediately prior to the pandemic and today.
Yeah, it's interesting. We came into the pandemic with a very strong consumer credit characteristics. We saw modest leverage growth of 3.5% over 5 years. We saw consumer debt grow at 2.9% in the third quarter of 20 year over year. So it looked good. We had consumer confidence was high. We had a tight labor market and the economy was sound. What's happened since has been quite interesting. sitting in my chair in March, April, and May, it wouldn't have predicted sort of this K-shaped bifurcation, if you will. We've seen strong growth in spending in the housing-related market. You've seen it in healthcare and e-commerce. On the other side of that K, you've seen a dramatic drop in discretionary spending on leisure assets, on travel, hospitality. And it's been interesting to watch the K-shape even deepen as we get. And we're sitting here this morning on the eve of a second round of stimulus. It'll be interesting. But I'd like to point out, in that first round of stimulus, I don't think anyone would have predicted, Doug, that 60% of that stimulus money ended up was saved or was deleveraged by paying down credit. And that's an interesting outcome. And I'm not sure what will happen in the second round, but the first round saw a substantial deleveraging by the U.S. consumer. You also saw that show up with incremental savings of $1.3 trillion by the U.S. consumer. So for the most part, the prime, super prime, and maybe even the near prime consumer and their credit is in very good shape, notwithstanding the fact that we're in the midst of a pandemic.
And Steve, just to be clear, your client base all lives in that prime and super prime credit score business categorization. Is that correct?
Correct. It is, Doug. Yeah, we focus on if you're this morning and you're sitting in Wichita and your furnace says no longer working, we're going to finance that furnace for you. And that loan is going to end up with one of the 15 banks who purchase those loans, and we manage them for them. We don't play in that subprime or near prime space.
Let's talk a bit about what happens in 2021 as the U.S. economy recovers, both how consumers have built large cash positions and their overall debt loads, which you referenced, and how you see that impacting ECN's business.
Yeah, it's that we're seeing that two-headed drivers of deleveraging by the consumers and liquidity in the U.S. bank system and the Canadian bank system, which we'll chat about in a moment. But if I just talk about deleveraging for a second, Doug, if you look to U.S. consumer cards, consumer credit cards, it's about $1 trillion adjusted for inflation and constant dollars. I never would have thought in March or April we would see that $1 trillion, which has been relatively flat, setting aside the great credit crisis. It's now down to $850 billion. So that drop of $150 billion, I don't think anyone expected that level of deleveraging. And again, back to my comment about stimulus. So I think that bodes well for the recovery. And then that you combine that deleveraging with this increased level of savings, that $1.3 trillion I referred to earlier. It's been quite interesting, and you see it reflected in the balance sheets of both U.S. and Canadian banks with 20-30% growth in deposits. Those are our partners who are looking for more credit assets. I don't think anyone would have envisioned that happening, and I think it's the convergence of those three things. I think is going to set us up, exceedingly well here. My daughter jokes that we're going to come into the Roaring 20s, and I hope that's not the case because the Roaring 20s didn't end so well. But if you're older, you can reflect back in the 50s and 60s when you saw very strong economic expansion post World War II, and I think we're coming into a time, Doug, where we're set up for that.
An old professor of mine 40 years ago, I remember, saying something, and it stuck with me forever, that money never goes on sale. But for the last several years, money's been on sale. Money's been effectively free. And at some point, clearly, we're going to return to a more normal interest rate curve. How do you see that impacting your segment of the market?
Yeah, well, to your point about money being on sale, you're seeing U.S. banks with deposit rates on 1 to 5 year deposits in the 10 to 50 basis points, which is unheard of, and we would expect that to increase. But We don't see a substantial increase in the short term or midterm here, Doug. Probably returns to the 1 to 1.5%, cost of money, if you will, for our U.S. bank partners. By the way, that's where we were going into COVID, and there was strong demand. I think the thing that's changed for our bank partners is the level of liquidity that's come into the system. That reference earlier to the 25 to 30% growth in deposits, whether you're a Canadian U.S. bank, it seems to be relatively uniform. And I think that's going to stay for a while. Our businesses are growing, I think, almost at an unsustainable rate of 25 to 30%. I can see the next several years of growing at 20% because of this change in liquidity. I think at the same time, the U.S. regulators, whether it's a bank or credit union, life co, are not keen to see the banks move down the credit spectrum into near prime or subprime assets. So there's significant competition for those super prime and prime consumer credit assets, as we're seeing reflected in our asset values. So I don't see to answer your question, Doug, I don't see a big change in the next 2 to 3 years. Probably a little bit of inflation coming back. I'm sure you think about that in your role at DBRS, but I think manageable given what's in front of us.
Steve, I know that ECN has long-standing and deep relationships with your shareholders, but also with large brand name equipment suppliers in the home improvement and manufactured housing industries, as well as your credit card portfolio business. I wonder if you could spend a little time talking about those entities in a bit more detail. And I'm also thinking about who ECN's partners or investors are in your portfolio of credit assets. Can you talk about that for a bit?
Yeah, no, I'm glad you brought it up, Doug, because it can be a bit, given our business model, which tends to be a supply-based customer, it's a little bit confusing. So shareholders who are my boss are always top of mind because hopefully we're good stewards of capital. But setting aside the conversation about shareholders just for a minute, there really are two customers to ECN. It's where do we find these high quality loans? And to your reference, we are the exclusive partner for Lennox. Lennox is the largest HVAC company in the US. So if you're sitting at a kitchen table and your furnace is broken this morning, that's us there with Lennox offering that consumer, provided you're qualified, credit and documentation and about a 40-second experience at the kitchen table. Same thing with Allied or Beacon Roofing. We're an exclusive partner. If your roof is requiring repair and you need to spend $20,000 to get that fixed, chances are you're seeing us as the financial partner, or Owens Corning or Renai. There are a number of U.S. partners in our manufactured housing business, Colonial Homes. Those are all important partners who are the basis of originating our prime and super prime credit this coming year, about $3.5 billion of credit at the kitchen table, if you will. But the person who drives all this is the bank, the credit union, the life co, and the pension plan / sovereign wealth fund. Those are the ones who we originate assets for. We call them the investors in our loan programs. If you're an investor and you'd like to participate in our loan programs, it's probably about an 18-month process. We successfully announced a partnership with CPPIB. Quite proud of that. Our team was able to partner with CPPIB for $1 billion program to purchase prime and super prime home improvement loans over the next 2 years. That was an 18-month process of underwriting our business, understanding credit quality, how it performs through cycles, like the cycle we're seeing now, unfortunately, which is it's outperformed. And it's been a part of my strategic plan. When we invested in these businesses starting 5 years ago, they were all originating for U.S. banks. Our management team has kept that core customer, but we diversified it, Doug. We diversified it into credit unions. I'm a life co guy from the early part of my career, so we brought life insurers in, and the CPPIB sovereign wealth pension plan has been a growth area for us. If you look over the next 5 years, The U.S. banks will continue to be core partners, but I think you'll see a lot more life and pension plans. I like the life cos and pension plans because I consider the capital to be more sticky, that their appetite for the loan products or the credit card portfolios that are originating, there's a permanent need for those assets. It's a bit of a process because you're going to spend a fair amount of time underwriting us. But I think the expertise that my partners have in their credit assets will show through, and the performance is what matters. And our performance through the pandemic has been stellar. Our arrears are at levels, they're actually a bit below coming into the pandemic. Our deferments have gone away. We manage this money on behalf of our bank and life co and pension investors. It's not recourse to us, but we treat it as if it's our money, Doug. And I know I'm going on a bit, but it's a passion about the stewardship we have on behalf of our bank and institutional investors in our loans and our credit card portfolios. Sorry for a long-winded answer.
No, that's a terrific answer. So for those participants that might not be familiar with CPPIB, I would just say that they are the largest institutional investor in Canada by a considerable margin compared to most. And they manage the pension program on behalf of all Canadians. So they're a terrific partner to Steve, I know, and also to many other businesses around the world. Steve, as a somebody representing a credit agency, how do you think about balance sheet debt at ECN when you and your board think about your investment grade credit rating status?
Yeah, we have significant capital and liquidity for small to mid-sized businesses. We have the ability to borrow several billions of dollars, but we don't. Our business model is to originate assets on behalf of our partners. If I were a bank partner and I saw ECN's balance sheet growing, I would say, well, hold on, I thought those were my assets. So we have a very modest balance sheet. Our leverage today is about 0.5 to 1 debt to equity. That's a good operating rate, probably 0.4 to 0.6, not any more than that. I'm 60 years of age. I've been through 5 capital market disruptions. This has been the 5th. I think liquidity is always a great thing to have. My fishing boat is called liquidity. It's just something that you need to have. We've been able to take significant market share during this pandemic, Doug, because of that investment grade rating, and not because we're using it to leverage our balance sheet. But if you're the chief financial officer at a large manufacturer and you're thinking about outsourcing your sales finance to us, because that's what you're doing. If at the kitchen table, Lennox could have their own finance company, they use us. And that CFO of Lennox wants to know that we're going to be around for a period of time through a series of cycles. And most of our competitors don't enjoy investment grade rating. It's hugely important to me. Some of our shareholders who have left the scene thought we could buy back $1 billion of our stock. That was the fashionable thing to do, if you will, to leverage up a balance sheet and decrease the float. That's not, I don't believe it's a prudent way to run our company. So the investment grade rating matters on both sides of the border. It's a huge selling point when we're in the midst now. We're talking to a very large box retailer in the US. When you walk in and you go for the orange juice and the muffin, that's my daughter and I do. And you walk that HVAC alley where they're selling air conditioning and siding and windows as you go into the store. That home improvement business is very large, and we hope to pick up 1 or 2 of these big box retailers. All of those conversations with those large box retailers have started with our investment grade rating. They have other providers there currently. who are not investment grade, and I think they've struggled during this pandemic. We've had one of our large competitors that's lost significant share. They're a single B minus rated credit. Our triple B rating matters to us. So it turns out at 60 years of age that liquidity matters. And keeping your powder dry has really benefited us now. And you saw it when we reported our third quarter results, significant growth. But more importantly, I like to talk about the credit performance of the portfolios that we manage, because that's what really matters to us, Doug. If you're a large U.S. bank and we're managing your portfolio, every 2 or 3 years, the asset management commitment will be up and we'll have to reset it. And if the portfolio has performed within a performance band, chances are you're going to renew with us. If it hasn't, then you're probably not going to renew with us. It's not recourse to us, but the relationship is recourse.
So let me just pull on that thread for a minute. As many U.S. banks consider or reconsider what their core competencies are coming out of this pandemic, do you see opportunities to acquire or partner up on either new asset classes or new lines of business in the future?
Yeah, I would say my career has been in this non-sexy thing called vendor finance, and vendor finance is providing sales finance to North American, European, Asian manufacturers of equipment. Out of every piece of equipment sold this morning, 8 out of 10 will be sold with financing. Whether it's a Lennox furnace, or it's a Dell computer, or it's something else. And I think that's the area that we have over the 30 years developed an expertise in. So when our bank partners look at us, they see us as a vendor finance business. And I think we don't need to go outside that channel, Doug. We just got to go deeper. So if I'm in that nameless big box retailer this morning, and you're seeing all of that consumer equipment, whether it's siding or roofing or whatever, that's $1 billion to $2 billion channel. And by securing to us of financing flows, by securing those relationships on an exclusive basis, we could double ECN over the next 2 or 3 years. So I think getting very deep in those silos, looking at opportunities in Canada, because right now our relationship with Lennox, with Rinnai, with all of our partners allow us to expand our programs into Canada. That's an important marketplace. I think you'll see us come back to Canada here in the short term and operating those platforms. So I think there's lots of opportunity for us without having to change our box. And I think the other thing, Doug, if I can just for a second, talk about the consumer. The consumer today, 7 out of 10 consumers would prefer not to use their credit card for mid to large purchase. That study comes out of Citizens Bank, and then you combine that with a McKinsey study that showed that installment-based credit versus revolving credit, loans versus credit cards, the loan business at point of sale is growing at 3 to 4x that of the credit card business. So I think having a point of sale system that works and is effective is going to hold you instead in understanding what your manufacturing partner needs, and a sales finance partner is the key to success, and making sure your bank partner are getting the credit assets that they're looking for.
So you mentioned Canada. I'm mindful that we've got about 3 minutes left on the clock. I know you have some very deep banking relationships. You're a Toronto Stock Exchange listed company, and I know that the Canadian banks are very supportive of your business and your business model. Is it a competitive advantage using Canadian banks given their strong capital position, as well as their retail footprint and growing deposit bases in the United States? How do you think about that when you're balancing all of your banking relationships around North America?
Well, to your point, Doug, our heritage is in the Canadian financial services system. Our strengths are in the Canadian financial services system, underpinned by the Canadian banks. We do have U.S. bank partners, our friends at Truist would fall into that group and others, but, our deep relationships with our Canadian banks helps, because when you're out pitching that CFO at that large big box retailer and they're asking for a reference, isn't it nice to serve up the CEO at CIBC or Bank of Montreal or National Bank or elsewhere, along with the investment grade rating and along with, the committed liquidity or balance sheet? I don't believe in revolving liquidity, so I'm a term liquidity guy. So our bank facilities really are term loans, and those are all driven by the Canadian banking system. The Canadian banks will support businesses that have proven themselves, I believe, over a period of time. In my case, almost 30 years. Over 30 years now. But it's been an important ingredient of our success, Doug, in the U.S. marketplace. I like to say that ECN is one of the great Canadian export businesses, because we've been able to that capital with the support of our Canadian bank partners and grow the U.S. business.
That's a great place to end this discussion, Steve. And I want to thank you for your insight and perspective. I want to thank the organizers at the Montreal Forum for putting this together and drawing such a remarkable crowd of attendees. And I want to thank all of you for joining us here today. And with that, I will turn it back to our moderator, Ms. Clark. Thank you all.